Almost everything in the market is overpriced at this point, and when that happens, I like to dollar cost averaged into an index fund. So let's go ahead and figure out if SCHD is still the best bang for your buck when we compare it to the other dividend index funds, because I really want to figure out whether or not I should put my money into SCHD right now. And there's many different types of dividend index funds, right? There's covered call ETFs, income focused ones, and the ones your grandfather with saggy balls tend to favor. For someone that is 70 years old and retired, their idea of best dividend index fund will be different to that of someone hairy and awkward like you. But for the purposes of this video, I'm going to be examining the best dividend growth flavor, aka the best overall dividend ETF, an ETF that is suitable for someone that is 42 years old, the same way it would be wise for an 18-year-old, the best out there. And if you want to see a competition of income focused dividend ETFs, well, I already made a video on that once, so just go watch it. So here is how the video will unfold. There's no surprises on this ride. The table of contents for those of you who are listening instead of watching the video. But before we move on, some of us don't even know what an ETF, aka an index fund, is. So, as a quick refresher, an index fund, also known as an ETF, trades as one stock or share that makes up an entire industry or market. So like an index fund of the S&P 500, an ETF of all the African fast food companies, or online dating apps like christiansingles.com. So think of an ETF as one stock, but within that one stock, there's going to be an entire portfolio of companies. And there's pros and cons to this methodology, but as you can see on your screen right now, it diversifies the risk. So let's go ahead and assume the NFL's NFC West is an ETF with four holdings: the Seahawks, the Rams, the 49ers, and the Cardinals. If you only invested into the San Francisco 49ers, which is this one right here, you would be down by negative 10%. But because you bought into the NFC West ETF, your total return is going to be 0%. In this delusional reality, the Seattle Seahawks has saved the team. Now let's go ahead and move on to the first dividend ETF. First one is the Vanguard Utilities Index, ticker symbol VPU. And believe it or not, utilities used to be a dividend favorite. But these days, it seems like dividend investors would rather prefer tobacco companies and food operations like Starbucks and McDonald's in their silly little portfolio. And no, I did not mention Burger King because their burgers are just butthole. Yes, that statement is coming from a dividend compounder with cheese. Da-dun-ts. But jokes aside, regardless of what dividend stocks you like, utilities have a pretty juicy dividend yield, unless of course your negligence leads to a lot of house fires in California and you go bankrupt. Then of course your dividend goes out the window. But for the most part, utilities tend to be safer than other industries. The dividend yield is pretty steady at about 3%. It fluctuates between these two numbers right here. And that's because the share price grows at a rate where the dividend yield remains at that level. It's pretty neat. The year-to-date performance is about 16.5%, which is pretty good. Top holdings include NextEra Energy and Southern Company, both utility powerhouses in the US, which by the way, when NextEra was trading at their 52-week low, I was thinking about pulling the trigger, but I just didn't, and I kind of regret it now. And it just goes to show, whenever there's a high quality company going on a discount for irrational reasons, for me and my own experience, that's usually the best time to buy them because you're buying them on a discount. And on the left side of your screen is the top 10 holdings of the ETF. And as you can see, NextEra makes up about 12.8% of the portfolio, and then Southern Company and so forth. Next up, we have the Real Estate Index Fund, which is made up of various REITs and property lending businesses. The ticker symbol is VNQ, and year to date, they are up by 3.2%, which is kind of sad and bad. But that's because real estate as a whole is on a discount because of the high interest rates environment. My prediction, please don't burn me at the stake because I'm not a witch. But once the federal bank starts to cut the interest rates, I think real estate is going to be a desirable industry once again. But what do I know? I'm an idiot. This ETF historically has had a dividend yield range from 3% all the way up to 5%, depending on how the portfolio managers buy and sell stocks. However, right now, the dividend yield is currently at 3.9%, which I think is pretty good. However, the dividend payments are not qualified. So do with that what you will. Just don't shove it up your booty hole, meaning it's going to be taxed at your ordinary income rate. Top holdings in the portfolio include American Tower, which rents out cell towers to companies, Equinix, which rents out data centers, and Prologis, the logistics warehouse company. Left side of your screen are the top 10 holdings, and yes, our beloved and dearest Realty Income Corporation is right here. It makes up 2.9% of the portfolio. Next dividend ETF is DIVY, and this ETF tracks the Dow Jones dividend companies that pay a nice yield. Yes, that's pretty subjective, but according to their strategy, they go for the top 100 highest yielding companies in the Dow Jones, excluding REITs. And they have a whole list of criteria standards that they look for, right? Like number one, the market cap of the company needs to be at least $2 billion, and in a perfect world, $3 billion or higher, and a record of 5 years of consistent dividends, and some other criteria points. And after reading their documents, I would say it's a pretty solid strategy, because to be a part of this dividend list of Divvy, you can't be utter trash like your moral compass on a Monday night when you watch the news and how angry you get every evening. Year to date, Divvy is up by 9.7%, and the dividend yield ranges from 3 to 4.5%. The current dividend yield is 3.7%, which is respectable with a capital R, and Divvy has 105 different holdings in their portfolio, with the top 4 being shown on your screen right now. We got Citizens Bank, AT&T, Altria, and Philip Morris. The top 10 holdings are all old school, old money type of companies, and I say that because tech only makes up 3.9% of the portfolio. The biggest sectors represented are the utilities at 28% and finance at 26%. It's not the worst thing in the world, and I would say it's a lot better than stubbing your toe in the dark when you get up to pee at 2 a.m. It's good and it's kind of bad at the same time. Next dividend ETF is the total US bond market, ticker symbol BND. Its strategy is to buy bonds from governments and corporations, and then to give those distributions right back to you in the form of a 3% dividend yield. It ranges from 2 to 3%, and as of right now, it's 3.3%. And year to date, bond is up by 1.8%. Yes, you heard that correctly, only 1.8%. And almost all of the top 100 holdings of bond are in treasury notes. And treasury notes usually pay their interest every 6 months. And not that you care, but T notes usually mature within 2 to 10 years, depending on the type. Whereas when we think about treasury bonds, they usually mature in like 20 or 30 or 40 years. And after hearing all that, you might be like, what the heck? Why is a bond ETF included on this list? Because believe it or not, there's some people out here that truly believe bonds to be the way to go. They say that it's a good hedge for inflation and risk associated with the overall stock market. And to that, I say, it couldn't be me. I am a no bonds type of guy, but I see the appeal and the argument, but I'm still not going to include it in my portfolio. And when we see a breakdown of the holdings, 50%, which is highlighted by this circle right here, are in government bonds and notes. The people that buy treasury notes and bonds are usually the ones on the far end of the risk scale. They would rather have a safe option and miss out on stocks and all of those gains. The same type of people to drink water during an NFL game day. Again, that couldn't be me. Next is the Vanguard High Dividend Yield ETF, ticker symbol VYM. And as its name might suggest, the portfolio consists of companies that pay a juicy dividend. Kind of like SCHD when I think about it, except instead of the Dow Jones Dividend 100 Index, Vanguard follows the FTSE High Dividend Yield Index, and it has about 551 holdings in its portfolio. Year to date, it's up by 10.2%, and the dividend yield usually ranges from about 2.5 to 4%. The current dividend yield is sitting at 2.8%, which is not bad at all. Top 2 holdings, JP Morgan Chase and Broadcom. And when we look at Vanguard's High Dividend Yield Index Fund, their top 10 holdings, Pretty cute. They have about 21% of their portfolio allocated towards finance companies, and then they share an equal love for tech, industrials, consumer staples, and healthcare at about 12% each. I think BYM has a pretty balanced approach, I would say. It reminds me of the people that are trying to lose weight by crushing fast food all day and all week, but they justify it with their effort in losing weight by drinking Diet Coke. Yes, I'm sure that Diet Coke is the variable that will tip the odds in your favor, pal. No, but on that note, I have been drinking soda again, and it's made by this company called Zevia. And instead of using sugar or other artificial sweeteners, they only use stevia extract for their soda. And I can tell you right now, I think it's a 10 out of 10 beverage, and I cannot wait to see Keurig Dr. Pepper buy them out because they are publicly traded, which is pretty insane. And I say that because I don't know if Coca-Cola or Pepsi has it in them to buy Zevia. Like, that type of acquisition just doesn't really make sense for them. And last but not least, the undisputed heavyweight champion of the world, the one, the only, Johnny Bones Jones. I mean SCHD, the crowd favorite. This dividend ETF tracks the Dow Jones Dividend 100 Index, and it has 97 to 100 holdings at a given moment in their portfolio. Year to date, they are up by 7.2%, and the dividend yield is currently sitting at 3.4%. Top two holdings, we got Lockheed Martin and AbbVie. Which, as you may or may not know, I used to work in the healthcare industry, and I actually had an opportunity to join AbbVie, except that I blew my interview. And I'm sure the recruiter probably thought I was a total idiot. It's pretty funny looking back on it now. On the left is the top 10 holdings of the portfolio, and as we just learned, the biggest holding is Lockheed Martin, ticker symbol LMT, making up 4.5% of the portfolio. Lockheed Martin, if you didn't know, they're in the business of making the best fighter jet planes in the world, and they help the United States Air Force to stay best in class. If there's a war around the corner, LMT usually tends to skyrocket in valuation, and when we look at the portfolio breakdown, it skews heavy towards the financial industry and also the healthcare space. I would also throw in consumer staples like grocery items and shampoo, which, by the way, back in college, I went through this stupid phase where I did no shampoo for a year or two. This was back in 2010. I know, disgusting. And say what you want, but my hair was actually pretty decent. These days, I'm doing the whole shampoo and conditioner routine. I just don't know how I went so long without using shampoo. It's pretty weird. And before we move on to the next metric, the Premier League is finally back. Thank goodness, because I was so bored, I started venturing into listening to history podcasts and whatnot. And I think history is still cool, but football season is finally back. Not only the NFL and college football, but also soccer all around the world. Yes, it's called soccer. Shut up. So let's just hope that my productivity doesn't take a hit. But anyhow, sad to say, my team, what you see right here, Tottenham Hotspurs, had a draw against Leicester City in the first match. Like, what the hell? All I'm trying to say is that we should have won the game, but it's the same problem that we had last year. We just can't finish. The team looks much better and the chemistry looks great. Angie Ball is working, but we cannot score goals. It's almost funny, but also frustrating beyond belief. It's the life I chose when I signed up to be a Tottenham fan. And now back to the video. By the way, did you know that it's absolutely free to click the like button on this video? I'm not even asking for you to sign up on a sketchy ass cryptocurrency platform. Just a simple like is all. If not, it's okay. Your son's boyfriend will click like on it later. Now we are going to look at their past performance. First up is the utilities. For the past 10 years, the utilities index fund has gone up by 140%, which was pretty surprising to say the least. I did not expect that from them. The 10-year annual CAGR for utilities has been 9.3%, meaning your money would have grown at a rate of 9% each year for the past 10 years. Real estate, on the other hand, went up by 77% in 10 years, and their 10-year annual CAGR Kager has been 5.9%, which is not the worst thing in the world, but it's not good either. It's kind of like being the village hunter that catches nothing for the day and for the week. So you pitch the idea of intermittent fasting to the tribal chief, and everybody buys into the idea of fasting because you sucked. For Divi, they're up by 142%, and their 10-year annual CAGR has been 9.4%, which is slightly better than the utilities, oddly enough. For the total bond market, the total return is 18% in 10 years, and the annual CAGR is just 1.6%. Just atrocious, like putting sugar in spaghetti sauce. I don't know why food companies bother with putting sugar into pasta sauce. I'm not even Italian, and that pisses me off. Like, why do that? For Vanguard's high dividend yield ETF, the 10-year return is 153%, and the 10-year annual CAGR is 9.8%. So far, this one is the best. Until we run into SCHD. The king is here. The king has been up by 197% in 10 years, and the annual CAGR is 11.6%. Even though it's been pretty flat for the past few years, it still blows the competition out of the water. SCHD, friends and family. Are you seriously going to move past this point in the video without tapping that like button? I bet you're the same type of guy to avoid eye contact and walk past the people asking for donations towards orphans during Christmas time. You're that guy. No, but really, haven't you noticed how the tipping culture has gotten out of hand? Everybody has raised their minimum tip amount from 12% like it was back in the day. Now it's 25%. It's absolutely crazy. Why can't the employers just properly pay their staff so that the customers don't have to bear that burden? Anyways, next up, we're going to take a look at each one of their dividend history. First up is the Utilities ETF. Back in 2014, you got $3.09 in dividends. Last year, it was $4.78. For the past 10 years, Utilities has been growing their dividend payment on average by 4.6% each year. Not bad at all. I'm really surprised by Utilities' performance in all metrics so far. Next is real estate. Back in 2014, you got $2.92 in dividends. And last year, now it's $3.49. For the past 10 years, real estate has been growing their dividend payment on average by 2.5%. This is less than desirable, friends. For Divvy, the dividend payment went from $2.41 to $4.48 over the past 10 years. Just look at this growth. This is beautiful. Divvy's dividend growth rate has been 7.2% for that same time period. Bond ETF's dividend went from $2.29 a share to $2.27 a share as of last year. This is disgusting. This is ugly. The best part is, bonds has been growing the dividend by 1.7%. What a lovely investment option. Vanguard's high dividend yield ETF's dividend went from $1.91 back in 2014 all the way up to $3.48 as of last year, and they grew their dividends by 6.8% each year. This is good. For SCHD, the dividend went from $1.05 all the way up to $2.66 as of last year. For the past 10 years, SCHD has been growing their dividend payment on average by 11%. So if you're keeping track, SCHD wins this metric as well, although Divvy was a close second. Now let's see what happens with a hypothetical $100,000 invested into each dividend ETF for the next 20 years, with the dividends reinvested, of course. Now let's talk about the assumptions. I'm just going to look at what the data says and assume the following share appreciation rates based on the past 10 years. And you're right, Michael, past performance is not indicative of future gains, but shut up and let's allow the data to speak for themselves. I'm also going to be plugging in the 10-year dividend growth rate from the previous slides. So with all the assumptions out of the way, the results are pretty interesting to say the least. And remember, this is the transformation of 100K over 20 years. So for VPU, the utilities, that's going to transform into $1.7 million. Pretty good. And then VNQ for real estate, that's going to be $700,000. Not so good once you take a look at the performance of utilities. And for Divvy, what's going to happen? For Divvy, that's going to be $2 million. And for bonds, Well, that's going to be $260,000. Atrocious. Vanguard's high dividend yield is going to become $2.2 million. So far, they're the winner. And then we have the king. Well, the king turns into $4.9 million. My goodness gracious. So, after going through the entire table of contents, how will I rank these dividend ETFs? Let's figure that out on the next slide. I already know some of you keyboard warriors are going to get pissed off that your favorite dividend ETF is going to be on the bottom of the list. But bear with me, because this is going to be totally objective. I'm just kidding. It's subjective. It's only my opinion. So, number 6 is going to be, I think that's fun, right? Let's do it from the bottom up. Who do you think it's going to be? Because it is bonds, number 6. I just don't see a place for them in my portfolio, and I would never recommend to my friends and family to invest in bonds as well. Number 5, fifth place, is going to be real estate, which, as you heard my investing thesis earlier, I think they are under the radar right now. They're going to have a bounce back this upcoming year. Just my prediction. I could be wrong, though. Who knows? Number 4, fourth place is going to be the utilities sector. They actually did pretty well, surprisingly. Number 3 is going to be Divvy. I think they're a tier 2 prince. Really. If you invest into Divvy, I can absolutely see why. I think it's a solid dividend index fund, which means number 2 is going to be SCHD. I'm just kidding. It's actually going to be Vanguard's high yield dividend index fund, which means number 1 is still the only John Bones. No, I'm just kidding. It is SCHD. The Royal King for good reason. And before you think I'm being a little harsh with bonds, check this out. If you bought into the bonds index fund 4 years ago in August for about $89 a share, you would still be down by 16.5%. After 4 years, you would still be in the red. And maybe this is a stupid point since this is an index fund, because if you would have just bought actual bonds from the government, you would be okay. But anyways, it still proves a point. So before people talk about how safe and awesome bonds are, I'm just not a believer. I would rather put my cash into a high yield savings account or a money market fund if I wanted to preserve and grow my capital for buying opportunities or to save up for a mortgage down payment or what have you. Because it's always good to have a bit of cash on hand when a solid dividend compounder goes on sale so that you can pull the trigger. Likewise, whenever I travel, I like to carry a bit of cash on hand, just in case the countryside gas station does not accept credit cards. Because the last thing I want to do is hitch a ride with a potential kidnapper. I've watched way too many Netflix documentaries about these killers, and I just don't want to take the risk. But I'll tell you what, if I were to get kidnapped, I think the first thing I would do is just poop my pants. That way, he wouldn't want to touch my ding dong, and I would just be smelling putrid. It would be my defense mechanism. Can you imagine trying to touch someone after they just poop themselves? I don't know, just what I would do. I think based on today's data and hypothetical simulation, SCHD stays on top. Regardless of my ranking, I really do think SCHD is the best pound for pound, bang for your buck dividend index fund out there. It's the king for good reason, and you better put respect to their name. And if I didn't have access to SCHD like our European friends, then the Vanguard's high yield dividend index fund is a solid option. Same with the BlackRock DIVY ETF. I think those are both really good alternatives. So there you have it, folks. I'll talk to you next time. Stay safe. See ya.